And then Tuesday was quite the day. Oh, so much information on Tuesday. At the start of the day, we were up 3 basis points on the UMBS. The 10-year was down 3 basis points. The recent pattern in overnight trading has seen a flatter trajectory in Asia, followed by a setting of a tone in Europe. Said tone can vary, but today's was largely rate-friendly as EU yields bounced back in line with yesterday's morning's lows. This coaxed Treasury yields in a similar direction, but with less urgency. Investors are wary of making big bets this morning before Powell speaks, which turned out to be a good idea. Many investors remained sidelined after being burnt repeatedly, betting on inflation peak, cooling U.S. economy, and Fed pivot point. While the S&P 500 index is up 2% this month, recouping some of February's losses, traders appear to be reluctant to push the gauge much higher until they have more clarity on inflation. So everything was all fine and dandy until about 8:30 Mountain Standard Time. Then everything went haywire as Powell began to speak. MBS were quickly down about 40 basis points. So far, it came through, and basically the highlights of what Fed Pres Powell said is, if totality of incoming data indicates faster tightening is warranted, we are prepared to increase the pace of rate hikes. The ultimate level of interest rate likely to be higher than previously anticipated. Later economic data stronger than expected, particularly inflationary pressures. Little sign of disinflation so far. Long way to go on getting inflation back down. We will stay the course until the job done. This is like the 6th time he said this. Wake up, people, and realize this isn't close to being done. Inflation going down from 6.5 to 6 is not anywhere near 2%. It isn't even progress towards the goal. Stop thinking they're close to being done. This isn't going to go well for the stock market and GDP numbers. That's just the way it goes. As Chris Maloney over Bank of Oklahoma pointed out, Powell referenced the 2% inflation target 6 times in the speech. It takes up just over 4 pages. He said 2%, not 5.5, not 5, not 4%, not 4 going down to 3 3/4, 2%. For those out there hoping to increase the target, I don't think that's a near-term possibility, and I pray that Powell sticks to 2% over the long haul. The difference between 2% and 3% for many Americans will mean the difference between a ham and cheese sandwich or a tin of cat food for lunch. This is the real-life aspect of things, people. This has to get back in line, and they have to put it there. Monetary policy works most quickly via most interest rate sensitive sectors of the economy. That's usually autos and housing. However, for very different reasons, both sectors have successfully resisted the impact of higher rates. Car sales are rising as semiconductor supply improves, while housing starts are way down. The number of units, both single-family and multi-family, under construction is staggeringly high, and this construction employment has yet to decline. We also got the JOLTS job summary, which showed 11 million job openings today, which is 57% higher than pre-pandemic, though there's a lot of problems with this data. There are way more remote work options now, so this just looks at listings. So one job could be listed in 10 different markets because it's remote. This could be a duplication of the listings. Those LinkedIn, ZipRecruiter, and Indeed are all showing job openings up about 25 to 30% versus 2019. Keep in mind, though, that the JOLTS has a sample size of like 21,000 versus 200 million on LinkedIn. Even though the Fed Chair Powell didn't say anything remarkably new or different, markets read enough into his delivery to change the course of the Fed fund rate expectations in a meaningful way. December's forecast per Fed funds futures was closer to 5.3% this morning, rose to 5.5% by 2 p.m. There was even a reaction for the meeting in 2 weeks. Markets don't see 50 basis points then yet, but the reaction suggests it could change if the NFP and CPI data come in hotter between now and then. I think 5.5 is going to be best case scenario on this. At the end of the day, we were down a total of 30 basis points. There was a little bit of a rally after it got worse, and a little bit of a rally, and then it got worse. The S&P 500 was down 60 points on the day, so ending up at 99.31. We are once again just above that black line, which is a Fibonacci line at 99.203. So we got a really tight set of 3 different resistance and floors here, which it seems to be holding right down that channel. So we'll have to see if there's some new data or if there's just some profit taking tomorrow because people have bet the right direction. We also got a post from our sponsors. So this is something that really can make a difference in your life because these are the things that you have control over. It's about the invisible selling machine. It helps you use quizzes, surveys, assessments, and sales material to cultivate customers. So this is another post about the invisible selling machine, of how you can create a machine that generates customers that are scrolling through social media. So check it out on our sponsor at WellThatMakesSense.com.